Crypto Kids, welcome back to another live show. Today, we're going to be looking at what's happening with the FOMC meeting. As you're coming into the live show, make sure to smash up the like button. That would be very much appreciated. But with that said, let's get straight into it. I'm testing out this new music. It seems pretty cool. Let me know if the audio is fine and if the music in the background is bothering you. So that would be, of course, very much appreciated to know if the stream is doing fine. But with that said, I mean, Bitcoin has been going pretty crazy over the past few days. I think it's normal to call this price action relatively crazy. We dumped from $71,200 to approximately $66,200 in just a matter of 48 hours. And I find that to be pretty hectic, to be honest with you. So I'll cover exactly why everything is happening and why what happened is currently on the chart, and how the FOMC will react or give a reaction to Bitcoin. So speaking of FOMC, let's have a look at what time the FOMC is going to be taking place. I believe it's going to be from 40 minutes from where we are. So the press conference is the most important one. Press conference is when the most amount of volatility hits the market, and that's the point where you want to stay tuned until. It can take, like, I'll give you a disclaimer, a heads up. The press conference can take hours, not hours, but like 1.5 hours. So we'll be streaming it live. I'll be taking notes in the meantime. And while I take notes, we'll do a quick recap at the end of the session. But leading up to 10:30, in approximately 8 minutes, we have the actual interest rate data coming out. I don't think that will create much of a price impact to Bitcoin, because if we look at the probability for the current rate that's going to be coming up in 8 minutes, there is a 99.4% chance that the interest rate is going to stay the same. And I'm seeing in the chat section, we're all George. Are you guys coming in from George's live stream? Yeah, I love George. He's an awesome guy. And by the way, let me know in the chat, where are you guys tuning in from and how late is it where you are currently, because it's currently 10 p.m. And to prepare for this live stream, I literally slept the entire day. I wasn't making videos on Monday and Tuesday. That's why I couldn't cover the crazy price action, because I had my final exam. So on Monday, I had back-to-back exams. Thankfully, they did fine. Funnily enough, it was about economics, and the macro paper looks at inflation and interest rates and how it works. Like, one question was, how does inflation affect an economy? What are the things that interest rates does to an economy and how to reduce inflation? So I went into like how the Federal Reserve was created back in 1908, and I waffled a lot, but I hope my teacher marks it well. So price of Bitcoin, what's happening here? And by the way, all of you guys are coming in from everywhere across the world. It's incredible to have such a diverse audience. We have Emmanuel coming in from Luxembourg. Thank you for tuning into the show, Emmanuel. We also have Tony coming in from Australia, 4 a.m. in Australia. Dude, what are you doing up at 4 a.m.? I guess, the FOMC is pretty important. Today, the CPI seemed to be the actual real price kind of changer here on the Bitcoin charts, and I'll get into it, as I said, in just a second. But Vanilla is coming in from Helsinki. Is Helsinki... Helsinki's Finland, right? If I'm not wrong, Helsinki should be Finland. P.RS is coming from Germany. Wie geht's? Alles gut? I hope alles is super. That was terrible German. Video Vandal is coming from the United Kingdom. Immortal Music is coming in from Chicago. Lucian is coming in from Romania. And Peggy is coming in from Atlanta. You guys are fantastic. Thank you so much for tuning in. I couldn't have wished for a better audience, so you guys are the best. Make sure to smash up those likes. Let's get this stream to as many people as possible across the world. Let's get into Bitcoin. I know I've been saying that for a while now, but let's actually get into the price of Bitcoin, because we're near the $70,000 region once again. Now, it's super funny because literally, like, we were at this price level approximately 48 hours ago during the weekend, and it was so boring and Bitcoin was doing nothing. And we're like, come on, Bitcoin, do something. And now Bitcoin is at the same price range again. And people are like, oh my God, Bitcoin is exploding to the moon. Guys, we need to control our emotions here. a part of why I didn't post a video during this crisis, because we had a beautiful, actually, if we look at the chart, we did have a beautiful head and shoulders pattern. So we discussed this triangle breakout. We discussed the beautiful retest which we had, which also appears to be a nice bullish pennant. And then we broke out from the bullish pennant from the prior 2021 all-time highs. And after that, Bitcoin came up to the crucial resistance of 71.4K. So 71.4K was hit, and we had a debate. There was a debate between the bulls and the bears. Is Bitcoin going to break up from this level? Can we continue to the $90,000 levels, or will Bitcoin get rejected? And to be honest with you, I was pretty hopeful that this was the time because overall, I'm pretty bullish on the stock market overall. I'll get into why. I had a meeting with my friend at Bloomberg just to understand what his views are on the TradeFi space in traditional finance. Does he see the markets going higher? And if so, why? And I got a lot of points from him, and I actually took down a lot of those notes, so I will cover that in today's stream. So 71.4 was the equilibrium which supply met demand, and we couldn't break out. Unfortunately, this was not the time. We got rejected, and we formed a beautiful head and shoulders pattern. So this was a beautiful head and shoulders pattern. You can go down into the 1 hourly and call this topping out formation a Bart Simpson pattern. And I know you're all going to mock me in the comment section now, but look, with my experience with Bitcoin, the Bart Simpson pattern does tend to play out, especially if you are at a top of the range. So Bart Simpson pattern down into a beautiful bear flag. And after we hit the bear flag, Bitcoin crashed to the orange support and resistance range that I've had on this chart for literally, I think, March of this year. It feels like such a long time, and Bitcoin is still in this consolidation period. We're still not escaping out. It's like the third consolidation period that Bitcoin has had in this parabola. My analysis remains the same. I think this ascending triangle is very important, and it's very important for Bitcoin not to create a double top, which it looks like we've been saved by the bell over here because Bitcoin, we reversed from 66. If we couldn't have reversed, then things would have been very, very bad for Bitcoin. Like, I was getting genuinely concerned, and I had to hold myself from making a video saying, Bitcoin, it's over. Game over for Bitcoin. I'm out. I was this close to making it, but I said, look, I think let's wait it out here. Let's see what FOMC brings to us. Let's see how the CPI data comes out, because the Dixie, the value of the dollar, will get heavily impacted if the inflation rate turns out to be lower than expected. And that's what happened. The inflation rate came out at 3.4%. If we go to trading economics, we can see the United States inflation data. We can go to core, because core inflation excludes the volatile sectors such as housing, energy, etc. And that is the Fed's preferred inflation metric to determine what the interest rate is going to be. So we can see that the core inflation rate came out at 3.4%, down from 3.6%, and the consensus expectation was 3.5%. That's amazing. And now we can see that the following CPI data is expected to be 3.2%. Inflation is in a downtrend. That is bad for the economy. Why? Usually, economy, for sure it's good for the economy, but for the dollar value itself. Because when inflation goes down, the Federal Reserve is incentivized to keep rates at a They want to reduce the interest rates when they come close to the 2% inflation target. There's no point in keeping rates higher for longer. So they reduce rates, and then people can start borrowing money again, and then they can inject it into the economy. And there's no point to really store your assets on the dollar to keep yourself in a safe haven. You can just invest in Bitcoin or the stock market instead. So that's why the value of the dollar decreased, and now we're seeing a push up on Bitcoin. That's it. It has nothing to do with particular news about Bitcoin or anything else. It's literally because the value of the dollar decreased, so Bitcoin has gone up. That's the entire point. And I think in the macro, the value of the dollar will potentially decrease for a longer amount of time in the future, and that will skyrocket Bitcoin to $1 million, etc. But those things I'll get into after we announce the interest rate decision, because the interest rate is probably, it should have come out right now. So let's have a look at that. But in the meantime, I want to check the chat because people are tuning in from Belgium, from Sweden. Ricard is coming in from tuning in from Sweden. That's pretty dope. We have Tharindu coming in from Sri Lanka. It's crazy. Like California. I can't believe it. When I was 12 years old, I would have never ever thought that this many people would be watching me speaking about economics, and I can see people from all across the world, which is fantastic. So thank you guys so much once again. Let's have a look at the interest rate decision. That should have come out literally right now. So let's go into Brave once again and look over here. If we refresh Forex Factory, yeah, it looks like it's exactly the same. I think I saw a sneak peek. Let's go to the FOMC. There we go. Federal funds rate 5.5%. Previous was also 5.5%. So it stayed the same. It came out as expected in the market, which is good for now because if we did have a Fed pivot today, then the market would have absolutely probably exploded towards the upside. And I don't think I was ready for that. Like, I need to prepare for a Bitcoin explosion to $90,000. It will happen at some point, but if it happened right now, I probably wouldn't have been able to grasp the entire concept. So it's good. Interest rates have stayed at the same level. I think they're at record levels in terms of how high it's been for such a long amount of time. But the expectation is that they will start being cut in either July or September of this year, given the fact that inflation is decreasing. Yes, Canada started reducing their rates because they had 1.6% inflation, below their 2% goal. The European Union also decided to decrease their interest rates because they were at 2.9% inflation, so it makes sense for them. But the US can continue having higher rates for a higher amount of time because their economy is stronger than the other countries. But eventually, just like Canada, just like the European Union, we will also get rate cuts in the US, and that should absolutely explode markets going towards the upside. People are saying Bitcoin is exploding. Is that what is happening? Let's have a look. No. Wow, okay, there is a lot of volatility. I mean, Bitcoin decided to be super volatile today. I've not expected, I personally did not expect this much or this big of a movement to be coming on, because usually we do get some sort of volatility, but it's like 2% maximum. We don't get like a push towards the upside of approximately 5%. We don't see that with Bitcoin. I think people were really hopeful of interest rates coming down eventually, and CPI is a massive metric for that. So I think Bitcoin decided to be the volatile asset here, reacting better or actually first before the S&P 500. Remember, Bitcoin is an asset that is online 24/7. So whatever there is in the market, Bitcoin is the first to get a reaction. I need to switch on the AC, by the way, as soon as we start streaming the FOMC because it's boiling in this room and I'm wearing a hoodie. I shouldn't have done that. That was probably a bad idea. But Bitcoin, what is my expectation here? Well, honestly, I don't like to trade any economic news event. It's just too volatile for my liking. So what I do is instead, I like to sit out and just watch and analyze what happens. I do not like to trade it because it's just so extreme. Like, nobody would have predicted that this month's economic inflation data would have been lower than before. It's an absolute gamble in my opinion, and that's why I'm just staying on the sidelines here. I'm going to wait. My bull case scenario is that we break the upper Bollinger Band, which should be here. So the upper Bollinger Band, I need to reset the settings, but the upper Bollinger Band is at $72,000 if I'm not wrong. If we can confirm a breakout on the 4-day time frame, then I think Bitcoin will explode. But let me go through the comments and have a sip of water because my mouth is running dry. Okay, let's go through the comments and let's test out the music actually. Let me know if the music is works fine. So I'm not sure how loud it's going to be from your end. So I'm going to just keep it here and you can let me know if the music is too high in volume or if it's okay. I'm excited. I'm excited for the FOMC, to be honest. It feels like a while since I did an FOMC stream. Mark is asking if I will make a video about FOMC tomorrow. It's a bit too loud. Okay, I will put it a little lower. So let's put it a little lower. like there. I will make a recap video. I think I will make a recap video, but do stay tuned. I would definitely recommend staying tuned until the end because we need to understand how the market will react today. Maybe tomorrow we have an extreme move and it will be too late. So I would definitely recommend watching until the end, Mark, instead of waiting for the video tomorrow. The market is seeing a little bit of a reversal here. It's crazy. I mean, the amount of volatility we're seeing over the past 48 hours, probably Bitcoin is not seen in a long time. And I do miss the volatility, but I'm just going to check out the volume from my phone just in case it's a little bit too loud because we did have the issue over on the Moon Show. So I will double check that. Give me 1 second. Because we did have the issue over on the Moon Show. So I will double check that. I think the music is too low in volume actually. So let me increase it a little bit. Let's put it up a notch. There we go. Cool. DJ Crypto Kid Vanilla. Vanilla is saying DJ Crypto Kid. Yeah, I like the concept of having music because I think it helps with your dopamine to not click off. So I wanted to experiment on today's live stream. Okay, you know what? Let's go through some of my notes because we still have 24 minutes until we get the FOMC press conference, and we will live stream the entire thing. So let me run through everything that I have taken note of, and I will make it into a newsletter eventually. But let's have a look here. So the first thing is PPI data. So PPI data came out yesterday or the day before, if I'm not wrong. And the reason why I wanted to talk about PPI because it's the producer prices change. It looks at the raw materials and the unfinished goods produced by manufacturers, and it's a pretty important metric. Actually, it's a very important metric to kind of observe behind the scenes, and it gives a very big determinant on how the inflation is going to be coming out. Because the producer price index looks at the overall, right, the overall goods and services produced by different manufacturers, etc., and it shows an indication of how much these raw materials have gone up in price. And the PPI data comes in before the CPI. And it's the perfect indication, as I said, to determine where CPI will go towards. And that came out higher than before. So I was expecting the CPI data to probably be the same, but no, it did shock everyone. And that's why Bitcoin had such a large reaction. So that's the PPI data. Now let's go into the bullish macro for stock market. Okay, so I had a meeting with my friend at Bloomberg. Shout out to Tom, amazing guy. And I'm pretty knowledgeable about the crypto space, but I don't have the same sort of information about the traditional finance space. I'm learning as we go along, but he's the expert and he's one of my mentors specifically for TradeFi. And I asked him, dude, like, what do you think will happen to the S&P? Do you think it will continue running towards the upside? Or do you think we'll have a crash going into a massive recession? What do you think is going to happen here? And he said, bro, I am completely bullish for the stock market. Remember, this is election year. And in election year, it's very, very tough for the government to allow a correction, a massive recession to take place. They just don't. And I know the SEC and the Federal Reserve should be independent organizations, but that's not how things work. In an election year, it's tough for them to cause a recession, even though if we go into the people, us, there is a huge cost of living crisis, and nobody can argue with that. The cost of living crisis is crazy. I mean, I put a picture up of 1 gallon of milk selling for $27. Things are expensive. Okay, so even though the stock market is pumping, like we can see on this chart, the cost of living crisis shows a different metric. And in fact, 50% of Americans believe that the stock market has declined over the past year instead of it going up. That just puts things into perspective. Regardless, money is being printed now. We're seeing the M2 money supply actually shifting into the positive. And whenever you print money, you essentially give free money by debt creation. When you reduce interest rates, and that's why I think they will also reduce it going into the election, when you reduce interest rates, then banks, institutions, they're incentivized to get cheaper loans. And when they get a cheaper loan from the bank, or when they get a loan from the bank, you're creating debt. And debt creates money, right? Debt creation is money printing. hence M2 money supply increases. And when firms get cheap loans, what they do with those loans is that they invest into their R&D, their research and development. They employ more people to grow their business. They invest in the stock market, etc. So it's overall very good for the economy in very simple terms. And because that is likely going to happen after the election, and especially if Trump wins, which it looks like he will according to the polling data, then the stock market will continue to rally regardless of how bad the cost of living crisis continues to be. And if you look at the national debt, yes, we're at like 35 trillion US dollars, but it's okay. As long as the value of the dollar or the dollar itself remains as the world reserve currency, then they can just continue to print more money to pay off those debts. So it's okay. And if we look at any contenders, any potential contenders around the world, there isn't any. Yes, there is the emergence of BRICS, but I think it will take a few more years until they develop their own currency. I think 2027 is their target. So up to that point, I think Bitcoin will continue to rally along with the stock market. And eventually, once we see a new reserve currency being established, that's the point where Bitcoin breaks out of that diminishing return cycle and goes to the $1 million target, goes to that $10 million target. But if you need to keep in mind that when Bitcoin goes to 1 million or $10 million in the next 10 to 15 years, you need to understand that if you discount the devaluation of the US dollar, which is the current reserve currency, then we would only be looking at a 2, 3, 4x from Bitcoin's current price, right? So let me reinstate that. Because the value of the dollar may drop in the next 10 to 15 years, Bitcoin will rally because of the inverse correlation. But if Bitcoin's at 10 million in 15 years, that could be only 3, 4, 5x pump from Bitcoin's current value today because we're discounting the dollar devaluation. So your job is to save yourself and hedge yourself against that potential loss in dollar value or the potential inflation that we see by buying into an asset. Whether that be gold, silver, or Bitcoin, that's up to you. But because we're having a new generation that's growing up in emerging technology like Gen Z and Alpha, when they grow up, right, I think they will naturally choose to buy Bitcoin instead of gold and silver. It's just more natural. I mean, imagine, I'm 16, right? I have some gold, some silver, but, if I wasn't educated in that part of the world, if I didn't know about those traditional methods, I think a lot more 16-year-olds know about Bitcoin compared to gold and silver. So it's just going to be much more natural to them. It's going to feel normal to buy Bitcoin compared to gold and silver. Currently, Gen X and baby boomers control most of the capital around the world, but eventually that capital is going to shift to the next generations. So once Gen Z eventually has the mass amount of money in the world, I think they will put their money into Bitcoin. So in essence, I think over time, Bitcoin will go a lot higher. I think Bitcoin will go a lot higher. And that is why I want to buy and hold, regardless of if Bitcoin's at 69, 70, 75, $100,000. That's the point that I'm trying to make. So that's kind of the macro outlook for Bitcoin. I know I talked a lot here, and you probably want to know what's going to be happening with the Fed interest rate announcement and how the FOMC meeting will be impacting Bitcoin. So we'll get into that right now, and then we'll go into the rest of the things that I have planned here, because I think it's pretty, it's interesting. Not many people pay attention to it, but you shouldn't lose your macro outlook. It's important not to get trapped into the 5%, 7% moves that Bitcoin has in these shorter term timeframes, because in the macro, we believe in Bitcoin, we believe in the technology, and that's why we're bullish, and that's why I'm streaming here at 10 p.m., because I know that Bitcoin will reward me if I continue working hard. But that concludes that part of the video. Let's go into the interest rates. For the people just tuning in 15 minutes, we have the FOMC press conference. That is basically the most volatile time that Bitcoin faces. CPI data came out today, and that was below the expectation. We're down 20 basis points from the prior CPI announcement, and that caused a huge expectation in the market that, look, okay, the Fed is about to pivot, they're going to reduce interest rates, and the entire market is going to continue to rally. That was why Bitcoin pumped from $66,000 to now almost $70,000. So the FOMC meeting is important because they already announced that it's going to be the same interest rate, 5.5%, no change. But when Chair Powell speaks, he will kind of give us an outlook of if they will continue with quantitative easing, or in the upcoming meetings, do they want to reduce that strict monetary policy, ease up the economy, and potentially give us some more headroom to go and continue bullish. Is there any breaking news in the market? Somebody asked. There is currently no breaking news. I think Trump posted a tweet on Truth Social. So let me find that. And in the meantime, I'll check the comment section too. Yeah, the Chinese real estate market is not doing too well. You're right, Javier. That's why there's currently no big contender for the US dollar. But eventually, I think if BRICS do end up creating their own currency, that will create a shakeout. That's what I personally believe. But let me find the what Trump mentioned, because it was pretty crazy. He posted something on Truth Social about Bitcoin miners, if I'm not wrong. Oh, there we go. Okay, found it. So if we switch here, we can see that President Trump said, "Vote for Trump. Bitcoin mining may be our last line of defense against a CBDC. President Biden's hatred of Bitcoin only helps China, Russia, and the left side of the world. We want all the remaining Bitcoin to be made in the USA. It will help us to be energy dominant." Is this true? Well, obviously, okay, people are saying the music is distracting, so I can reduce the music volume a little bit if you find it distracting. Thanks for that comment, Poli. It's cool, right? President Trump is obviously trying to get more votes here. That's my personal outlook, because a couple of days ago, he also said that I will unban TikTok if I enter the presidency. And if you remember, he was the biggest advocate into banning TikTok from the US. So now he's saying that if he does become president, he will unban it. He will not allow that to happen. And we talked about how 110 million people in the US essentially have Coinbase wallets, and even more have had exposure to Bitcoin. So in an election that's so tight, you have a lot of crypto people that are mostly single issue voters, right? So you have a lot of single issue voters that if we have policy and regulation that supports crypto, the crypto industry overall, and that's introduced by politicians, then obviously we're going to go, or the U.S. citizens, they will go and vote for that particular politician. And that could be enough to win an election. That is why President Biden allowed, in my opinion, for the Ethereum ETF to be passed. We're getting President Trump being very active about Bitcoin and cryptocurrencies over the past few weeks. So I think that's the entire reason behind these kind of announcements and these remarks shared by former President Trump. I wouldn't be too bullish about it because, as I said, I think in an election cycle, in election year particularly, any promise that is made usually is not introduced later on unless it's a part of their mandate. I don't think Bitcoin is a part of the mandate. So I'd be skeptical, but of course I think a Republican administration in charge is better than a left Democratic or a Democrat administration. I think overall that's probably better for Bitcoin's future. What's Bitcoin doing? We're not doing too much. 69.4. We've tested the prior all-time high of 2021. That's a very critical level of now support. So if Bitcoin's able to bounce, then we can even go ahead and try and reach 71.4 again. But honestly, I can't say much. During FOMC, Bitcoin is super, super volatile. We can actually go back we can go back and we can check how Bitcoin performed in prior FOMC meetings. And I think I do have a tweet for that. So let me go ahead and find it. I think in the prior FOMC meetings, Bitcoin did have an astronomical move upwards after the FOMC meeting has been announced. So let's go ahead and go back to the browser. We can see that during the FOMC meeting, specifically in this range that Bitcoin has been creating ever since March of this year, after the FOMC meeting, it essentially marked the Bitcoin local bottom. So back in March 18th, 19th, we had the FOMC. Boom, that marked a local bottom for Bitcoin. We pushed towards the upside. Then we had FOMC on May, and that was when Bitcoin was trading at $59,000, $60,000. FOMC meeting marks the bottom, Bitcoin pumps back up. And now we have FOMC once again. I think the same will probably take place. During this event, we'll have volatility, but over the next few days, I think Bitcoin will try and test that 71.4 area again. And if we go up to it one more time, it will become so weak that Bitcoin will have no other chance but to break it towards the upside. My macro outlook, very, very bullish. And yes, I will play Powell's speech as soon as it's live in 9 minutes. So I will be playing Powell's speech, and I'll mute myself. I'll take notes, and after the speech is over, then I'll go through the highlights of what took place, and we'll talk about the market impact at the same time. So stay tuned. It will be very, very nice. But as I was saying, I think Bitcoin will go back to 71.4, try to break out of it. And this time round, I mean, the more times you test a line of resistance or support, the weaker it gets. And I think this time, after 1, 2, 3, 4, 5, 6 tests on this resistance, I think it will become so weak that eventually will break towards the upside. So I think that is what will happen. Can Bitcoin go lower? Obviously, it's always a probability. If we do, 64K is the level to hold. If we go below 64, then between 64 and $60,000, there's not big support. You can argue 61.1 is support. And if we do dump to those levels, then Bitcoin is not creating a higher low. When you don't create a higher low, then you get a weekly double top, which is super, super bearish. So you want Bitcoin to bottom at minimum or at maximum 64K, so you can keep this ascending triangle going on, and Bitcoin can then continue to break bullish towards the upside and reach a target of initially $84,500. And that's my expectation. I think that is what will happen to Bitcoin. We can discuss what will happen to altcoins, and I do have a couple of altcoin picks that I'll share right before the FOMC meeting starts. We can go to Banter Bubbles and see the entire altcoin market is actually still getting destroyed if we zoom out to the weekly time frame. Of course, today we're having a big recovery amongst altcoins, but when we zoom out to the week, it's still lower than where they were when Bitcoin started to dump. So we can get the outlook that, yes, Bitcoin was at the same price as it was on Monday's start, but altcoins are still down 10, even 24% between that change of price move from 70K now again to $70,000. But I think altcoins will come back. They'll come back strong. Probably the time for meme coins is starting to be over as Bitcoin volatility starts to be more prominent again. And I think the money in crypto specifically will be transferred into the larger market cap altcoins such as Solana, Dogecoin, Ton, Avalanche, etc., Chainlink. I think the large cap altcoins, like if we look at Polygon, for example, and we go to the macro chart for Polygon, I think we're still down approximately, at least a 2.5x from the prior all-time highs. So these altcoins, when Bitcoin is currently at an all-time high, they're still down 2 to 3x from their prior highs. I think these will continue to run, particularly in summer. So I'm buying up a lot of large cap altcoins, and then I'm also going a bit more degen into play to earn projects. So if we go into play to earn, and wow, okay, that's a cool feature that CoinMarketCap added. You can see the token unlocks that will be coming up for the top tokens. Wow, Dogecoin has token unlocks? What? I had no clue. But it's only like $4,000. That's okay. That's okay. If we go to the categories and we go to GameFi, I'm buying a lot of GameFi projects. I think that GameFi will be the next sector in crypto that brings the billion users into this space and educate billions of people about crypto and blockchain technology. So I'm buying a lot of GameFi projects, and I'm literally dying of sweat here. It's so hot. So hopefully as soon as the FOMC meeting starts, I will turn up the AC because I'm literally dying and I'm running out of water too. So I will stack up on the water supply and make sure this room is a bit more cooler next time because it's so damn hot. But yeah, that's where I'm investing my money. We can go into Illuvium, which is a cool project that I personally like. Of course, always do your own due diligence, but Illuvium is down 20x-ish from its prior all-time high. And I find that to be crazy because we're seeing meme coins with absolutely no utility pump 100x. But tokens such as Illuvium is still down 20x from its prior all-time high. I find that to be very, very insane. It's crazy. Yes, please, guys. Let's get the likes up on the live stream. It would be incredible if we can smash 200 likes. We're so close to hitting 200 likes on the live, and if we do so, I will play some more music. If we reach 200, then we can party with the music right before the FOMC event. Dude, I regret not turning the AC on. It's so damn hot in here. Javier, yeah, I like Avalanche too. I think it's a pretty cool project, and the founder is Turkish, so we have that connection. Him being Turkish, I'm Turkish. Maybe we can do a video together. That would be cool. Crypto Kid is a grown man now. Yeah, I mean, look, honestly, I'm 17 in 1 month, and it's crazy the amount of things I've learned in a matter of just 1 year. And I'll do a video before I turn 17, just covering everything that I learned. I mean, if I go back in time to my videos that I made like a year ago, it's crazy the amount of knowledge initially that I have now compared to what I had back then. So I'm super happy with that. And I think the content is improving, which is the most important thing, to bring better content with better information for you. So I'm happy. I've learned a lot this year, and I can't wait to continue learning to bring even better content. What's the update on Bitcoin? Let's have a look. Nothing much. I mean, Bitcoin is just doing its thing. We're consolidating. We're waiting for the FOMC. After they launch their statement on what's happening with inflation and whatnot, then we'll get the press conference where reporters get to ask questions to the Fed chair. And those questions, some of them can be pretty difficult to answer. And those tend to pump or dump the market. So that's what we're waiting for. I think Bitcoin has reached a indecision, and we're waiting for what will take place in this event, and we will cover it live. We will go through the highlights after the event is over. It will probably take like 1 hour. He does speak for generally like 1 hour, 20 minutes. It is what it is. It is what it is. We'll cover it live here, and then we'll go into the highlights afterwards. Thanks, dude. Yeah, I mean, it was tough. I started learning about Bitcoin and crypto when I was 12. So I've been in this space for almost 5 years now, which is mind-blowing. But yeah, it's been a while. It's been a while since I've been in crypto. And I think I can't imagine doing anything else other than acting, which is my dream. But yeah, I'll always be in crypto. I love the space. I believe in the technology. I think that eventually everything is going to be on the blockchain. I think every single financial product across the world is going to be on the blockchain, because there's literally no other reason for it not to be. Currently, settlements take 1 to 3 business days. So if you are, let's say, Fidelity, okay, I have a brokerage account with you, Fidelity. I want to buy Tesla shares. I put an order to buy Tesla shares from you at market price. Okay, I put the order in. On paper, I have the Tesla shares, but essentially it's not. It will take 1 to 3 business days for that transaction to settle between Fidelity and the New York Stock Exchange. So it takes 3 days. 3 days for the settlement to happen. And that's mind-blowing, because you have a clearinghouse that has to check everything, has to cooperate with every single different exchange. It was introduced after the financial crisis that happened in 2008, because essentially there was not enough clearing houses that communicated between different JP Morgans and Morgan Stanleys to understand who has positions where, right? That's partially why the financial crash happened. But the DTCC employs like hundreds of people, right? Hundreds of people, takes a lot of time, not efficient. And if you have inefficient velocity of money, so if money cannot flow from one place to another in a fast speed, then you have reduced economic growth. So if you put all of this into blockchain, then you don't need the hundreds of people working in the background, checking everything, verifying all transactions, settling the transactions. You can just do it on the blockchain instantaneously without the 1 to 3 business day period. And that's why JP Morgan, BlackRock, they're all developing their own blockchain solutions currently and implementing tokenized money market funds and different ETFs, etc., because that is the future. And I think Bitcoin and blockchain projects overall will pump as soon as that takes place. So I'm excited for the future of Bitcoin and cryptocurrencies. I think we're still very, very early because, believe it or not, yes, there could be millions of people in crypto, but they're not as financially educated or not as aware about the things happening in crypto like you and me. So we're ahead of everyone in crypto and across the world. And I think it's the best industry to be in apart from AI and metaverse. So I'm happy. I'll probably be here for a while, not going anywhere. But with that said, let's go into the actual Federal Reserve live stream because that should have started. So let's go into that. Let me just double check. There we go. The Fed chair is walking in and he's about to say good afternoon, like he says in every event.
There were job losses in the household survey, job gains, big job gains in the establishment survey. So, I mean, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago, or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year. And as I mentioned earlier in the, what did we take away from this? We had really, really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. There are fewer rate cuts in the median this year, but there's one more next year. So if you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. The economy has repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina. Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. How should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now we can't really know that. That's an interesting dispute and discussion to have now. But ultimately, we think that things like the neutral rate are driven by longer run, slow-moving forces. And, there's a really good question about whether those really have changed, or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about, looking at the incoming data and asking how much progress are we making on inflation, and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on, we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal. And then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that, though. We're look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point. Not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. But so that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation, with growth at a good level, and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market, while we're continuing to make progress on inflation. So we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. Ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Chris.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and we've taken some signal from that. But and of course, housing services, you're continuing to see high readings there. To some extent, that's catch-up inflation from earlier pressures. But overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy, what you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to, approach this question carefully. And we will approach it carefully while we're very much keeping an eye on, downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We you always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably on 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction, but one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Jolene. Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
I don't think anyone knows, has a definitive answer why people are not as happy about the economy as they might be. And we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year, and I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, and particularly the second half of last year, and we continue to see still strong growth or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that, and that's not what happened. Instead, the U.S. is anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about. Your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there are renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants.
I'm not taking a nap. I'm just reading I'm reading Bloomberg actually and checking the stream. So I will give the update afterwards. Don't worry.
Of high past increases in market rents, it has to get worked off, and that may take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It just is going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward.
Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home, but...
Hold on. Credit card debt delinquencies at an all-time high. I will find the data. Just give me 1 second.
We're watching that carefully, and what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago, and we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as they're spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right though. We do see the same thing other people see, which is increasing financial pressures on more lower income people. And you know, the best thing we can do is to foster a very strong jobs economy, which we think we have done, ultimately to get inflation under control, because those people experience inflation, you know, very directly, very painfully. And you know, once we get inflation under control, rates can come down, which will also improve things.
Victoria.
Hi, Victoria Guida with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
You know, when I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. You know, the labor market, you know, has the ability, has the tendency sometimes to move and to weaken quickly. So waiting for that to happen is not what we're doing. You know, we're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So. And also the fact that we look at all of the whole situation. So, you know, a decision to begin to, loosen policy could have several reasons associated with it at a given time. But I would just, you know, we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I mean, I can think of things that many things would make it on that list, but I don't think I'll utter them here.
Thank you, Chair Powell. Simon Urbanovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that, you know, it looks like May will be quite good for PC as it was for CPI. Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project? You know,
I don't actually have that kind of mechanical thing in my thinking. I get that, you know, as many good ones as we had bad ones, but no, it's not like that. It's the whole, it's going to be the totality of the data. The labor market data, the growth data, in terms of inflation, you know, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things because that points to dates, and I just don't think we're not at a point of being able to do that.
Kosuke.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that the market should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't, actually it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has been, has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, you know, and for our economy, what we're trying to foster is maximum employment and price stability. And we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE, or at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once, you're well above neutral, to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation?
You know, so we're well aware of the two-sided risks here. Let me just say, we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is, you know, an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there. And you know, we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low, so we have the ability now to approach this question carefully, and that's what we're doing.
And just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Evan.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing, and all the other details. We don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't. There isn't any one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example, and we don't target wages. We target aggregate prices and overall employment. So,
but if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you'd look at we'd be looking at the aggregate numbers, and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
Okay, and it's done. There we go. That was it. That was it. Wow. Okay. Cool. If I go to TradingView, is it going to work? Let's check. TradingView is not going to share TradingView. Okay, so let me exit here. No. Bring back my audio. Bring back my audio. That's crazy. Why can I not? Okay, hold on. I need to exit from this, go back to TradingView, and then we should be able to share our screen and look at what Bitcoin did. I captured some notes, some important notes, and I will share all of that with you right now. I think a lot of things that were said, there's some element of exaggerating and element of untruth, let me just say, that was going on there. So I think, let me change the scene. We got to go to TradingView, and hopefully it works now. Perfect. Bitcoin had a little bit of a rejection down to 68.6, but it wasn't anything massive. It was okay. It wasn't anything massive. Bitcoin is currently consolidating at the prior all-time high, 69.1. This is an important point for Bitcoin to hold, because if we break down, then we continue with our bearish move downwards. If we can hold it and Bitcoin can bounce tomorrow, then perfect, right? We just need to wait for that. And honestly, am I taking any positions here? No. I want to wait until the market cools off, and then I'll look into maybe taking a scalp position. But honestly, I'm staying in my long. I'm not changing anything. What was mentioned in the press conference? That is something we need to get into, because there were a lot of exaggerations and not exact truths that I came across, and one of those is the fact about credit card delinquency. I actually highlighted it in the chat, so I will show you that in a couple of seconds. But I'm having so many issues during this live stream. I learned a lot. I mean, we didn't learn too much from the FOMC press conference, but I definitely learned that, number one, I think the music is a bit annoying, so I will remove the music from the next live streams. We'll only put it if there's nothing to say, we're waiting, etc. So music is going to be gone, and I've solved the audio issue, so we shouldn't be seeing that in the future. But let's go into credit card delinquency. And I remember Kubesi Letter over on X posted this chart, because we're currently at the highest level since 2011. Credit card delinquency, you can say it's in a local all-time high. And what this essentially means is that people have debt on their credit cards that they cannot pay off. I think the number is $15 trillion, and it's a terrible, terrible amount of debt. It's not good at all. It shows that there's a huge cost of living crisis. And if we go to Bloomberg, I saw a cool piece of information they shared, because we can look at the overall goods and services and how much they went up in value over the past year. And that typically gives you an understanding of, okay, has inflation actually gone down or not? Looking at the food at home basket, the only goods that are cheaper from a year ago are dairy products and related products. Prices for cereals, meat, fish, eggs, poultry, fruit, vegetables, beverages, and other food at home are all higher. That probably won't come as a surprise to the average shopper. So me and you, my mom shops in the grocery store, so I don't know too much, but I'm sure my mom complains all the time. I know, my mom knows that the prices of goods that we consume on a daily basis, these are inelastic goods, meaning that regardless of their price, the amount of consumption or purchasing from your side is going to stay the same, regardless of a change in price, because we need to consume meat, we need to consume eggs, cereal, whatever, right? So regardless of how much price move we see in these inelastic goods, our consumption and overall demand is not going to change too much. And I'll jump into Bitcoin in a second, because Andres is saying we're dumping more, but I need to talk through this. So we know that inflation is so high, and we know that this number right here, the core inflation rate, is clearly a joke, right? Because we also know that the housing market, I saw a shed, literally like a shed in the US, listed for $500,000, built in 1971, and it's terrible. Maybe I can find it later on, but the housing market is so high, people don't have enough money to pay for those prices of those ridiculous prices for homes, let alone they don't have enough money to put into Bitcoin. That's the important thing. The reason why retail is not here yet is because the retail does not have any money. The entire run that we're seeing driven into Bitcoin is completely from institutional adoption. Thank God we got BlackRock and the ETFs. If we did not have the ETFs, probably Bitcoin would be in the bin right now. And I'm happy. I'm happy that the ETFs are here because they literally just saved our butts from Bitcoin being at zero. But that's okay, right? We have the ETFs. We're grateful for them. And eventually, now that the money printer is going back up, I think I can bring the actual M2 money supply onto this chart. So if we put on the M2 money supply here on TradingView, we should be able to see that the amount of new money flowing into the economy over a monthly scale. So on the monthly scale, this indicator does not look accurate. That's fine. We can go to the Fred. So Fred is the official government economic data site. If we go to fred.com, fred.com will give us the fred.com. Here we go. That should give us the M2 money supply. So M2 money supply is trending back towards the upside. If we zoom in like very, very closely, you will see that the M2 is starting to trend up. That's good because money printing allows people to have economic stimuli, go and buy stuff, etc. It's good. It's good for the economy in the short run, but in the long run, it's of course bad because when you print money, then you have inflation again, then you have high interest rates again. It's a repeating cycle. It's based off of Keynesian economics. It's called a boom and bust cycle. You have a boom cycle and then you have a bust cycle because you have inflation, interest rates go up, then you implement quantitative easing to bring down inflation, then you bring down interest rates and boom, you have economic boom once again. And that just repeats on a cyclical structure, which is terrible because you have rising debt. If you want to save yourself from money printing, then you just need to print more money over time because your debt is increasing. How the hell will you pay off your debt? If we look at the treasury curves, this is the best indicator to look at if people are bullish on a country's economy in the short or long term. We can see that the short-term bonds, so the 1-2 year bonds, they have the highest rate of return because people are not bullish on the macro perspective for the US economy. In fact, this is called an inverted treasury curve, and the yield, so the treasury curve's yield, it looks at yield of bonds. The bond curve is at an inverted line, meaning that the short-term bonds have higher yields compared to the long-term ones for the past 500 plus days. The last time we saw this was in the Great Depression in 2007. So these things are showing me, yes, the economy is bad, but we just know for a fact that this is election year, and them creating a recession in the economy, in the stock market particularly, is probably not going to happen. It's just not how the world works. But I'll give you an update on Bitcoin again in a couple of seconds. But it's not really dumping. It's just like a couple $100. Come on, guys. We know better. We know better than that. Let's have a look at the recap from Bloomberg, my favorite mainstream woke company. It's the best. It's better than Reuters. It's better than CNBC. So I would definitely look at Bloomberg if you want to check out global news. It's probably the best option you have. This is the summary. So thank you for joining us. Here are 5 key takeaways from the May U.S. Consumer Price Index report released on Wednesday. The overall CPI was flat in May compared with April, the first time in almost 2 years that it did not climb. Thanks in part to a drop in gasoline prices on the month, the core index, which excludes food and energy, rose 0.2%, the least since last October, undershooting all but 12 of the 71 forecasts in Bloomberg's survey, which is cool, right? Services were the main reason why core inflation came in less than forecast, helped by a decline in car insurance and the biggest run up in prices in that category since the 1970s. Airline fares were also down. The so-called supercore services gauge, which excludes houses, dropped by 0.04%, the first decline since 2021, and boding well for the Fed's preferred inflation gauge, the PCE, which is out later this month. The annual rate of core inflation came down to 3.4%, the data that we looked at, the lowest since April of 2021, aided by the smallest increase in housing costs in more than 2 years. Headline CPI came in at 3.3%. The release boosted the likelihood of Fed policymakers projecting 2 rate cuts for 2024 when they released their updated forecast later on Wednesday. economist said, interest rate futures showed increased bets on the Fed kicking off rate cuts in September. Treasuries and stocks climbed while the dollar slid. 2-year Treasury yields were down about 16 basis points, et cetera, et cetera, et cetera. So nothing too crazy happened during this FOMC conference. It was boring, but at least a bit more exciting in terms of price compared to other FOMC events for sure, which is a good thing. And Bitcoin apparently is down to 68K once again. So let's have a look if is that the case or is that not the case? Because if it's down to 68, then our analysis does shift a little bit. Wow. Okay, that is a wow. Damn. Okay, that is a correction. I'm not going to call it like a crash. I don't think this is a crash, but it is definitely a sizable correction on the 4-hourly time frame. Look, it's important that we hold above 67.2. I'll leave you guys with this. It's important that Bitcoin holds above 67.2K because that is the neckline for a potential double top scenario we have right over here. Okay? This is the neckline for a potential daily double top scenario which Bitcoin is projecting. If Bitcoin can remain above 67.2, I think we will have another chance of hitting 71.4 and eventually breaking in a bullish manner. But if we break down 65.2 and overall 64 is my final buy the dip opportunity. But guys, I'm going to have to cut it off here because I am running out of battery. So guys and girls, thank you so much for tuning in. We had some technical difficulties, but it worked out for the best. Thank you so much for coming on. Have a great day, everyone. After FOMC, the price of Bitcoin bottoms out over time in the macro perspective, and we rally higher, so my bullish bias is in play. But thank you for tuning in. Have a great day, and bye-bye.